Good morning, everybody, and welcome to this Hafnia presentation of the Q3. Welcome to you, the CEO, Michael Skov, and my name is Ture Østergaard. I'm with HC Andersen Capital, and I will be the moderator. If you have any questions, please put them in the chat. I'll make sure they are asked. So you're very welcome to ask any question you may have. Welcome to you, Michael.
Thank you.
And we'll take approximately 20 minutes, and hopefully there's a lot of questions. If not, then we have plenty of things to discuss. But we will give you an overview of Q3, dig a little bit into the financials, and of course into the fundamentals of the tanker business and Hafnia's business. So welcome everybody. And Michael, I think let's just take the brief introduction to Hafnia once again. But if there's new viewers out there, please.
Absolutely. And yes, and thank you for hosting this. Looking forward to going through the highlights of our third quarter results for 2023. So very briefly about Hafnia, as you can see on this slide. So we are one of the largest global product tanker owners and operators in the world. So that basically means that we are transporting refined oil products such as jet fuel, gasoline, diesel oil, etc. We control at the moment financially 128 vessels. We had an NAV at the end of Q3 of $3.6 billion. We have a modern fleet, which is important in these days, and I think we'll get into that during the presentation, of just above 8 years. And we are listed on the Oslo Stock Exchange under the ticker Hafnia. Hafnia is a relatively young company that has grown since 2011, really through acquisitions and different combinations, merger and acquisitions overall, and have managed to, in that period, been what we call very focused on active management, which basically means that we have been super active in trying to look for long-term solutions to grow the company rather than wait for the market to produce the results. So I think we've been super well positioned now that we've seen the markets improve a lot as they've done over the last year and a half. And that's really much down to the fact is that we continue to try to be in the market looking for accretive transactions that will help grow the company going further. In addition to the ships that we own and operate, we also operate other people's vessels. So financial investors that want to own a ship but doesn't want to have a big operation around it can buy a vessel and give it to us, and we will then make sure that there is a commercial management of the ships. So we do that with quite a lot of vessels, external partners. So that means in addition to the 128 ships, we have more than 80 vessels that we operate from third-party clients. So that means that we effectively control in the market more than 200 vessels worldwide.
Thank you, Michael. And then let's get into the Q3. You announced the Q3 on Friday, so this is pretty new information, and I thought it was worthwhile going through these. I believe when you say key updates, it's the most relevant things you want us to know. So maybe you take this slide, please.
Yeah, so exactly. We try to highlight some of the things in addition to the financial part that has happened in the quarter. And as you can see here, we're very happy to welcome the Hafnia Larvik, which is one of our new builds that has a dual fuel engine, which basically means that besides burning traditional fuel for the propulsion, i.e. for getting the vessel to move, we can also use LNG, and going forward we can even modify it further to use ammonia. So it's a vessel that's actually adaptable to a renewable world going forward. So it's the third of 4 new builds of that kind that we have. They're all put out on a long-term agreement, so we have secured income for up to 7 years in these ships. But very pleased for Hafnia to show that we are also in a transition towards the more renewable future. And in a way linked up to that, you can say we also announced that we've done a sustainability-linked credit facility of about $300 million. So what that basically means is that we have created a financial tool. This is not the first one, I have to say. We have a few of those already that basically makes sure that we as an owner also have certain sustainability goals that we have to live up to in order to keep this finance. So both of these initiatives are really 2 things that helps Hafnia move in the right direction, that we continuously try to improve on our environmental footprint as we go forward, And I'm happy to say that we are well below the international regulations for what companies have to do in shipping in terms of staying on a reduced trajectory in terms of all emissions that you send out as a company. And then finally, we have announced that we are now pursuing a dual listing in the US. So that means in addition to our current listing in Oslo, we are now pursuing a listing as well in New York. So this doesn't mean that we are changing from Oslo to New York. It just basically means that we are adding on the current listing because we feel that there is a large interest also among US investors. And we feel by having a listing in both places, we're catering very well for two very important parts of the investor environment in the world. So hopefully that will give us even more investor interest and subsequently better pricing of our shares going forward.
And perhaps just digging into that a little bit, because that's a new thing, brand new thing, and of course there's a US dollar market for tanker shares that you want to dip into. I guess that's the main reasoning. But for us investors in the Nordic countries, there's basically no change, and there's also no change to dividend policy. Is that correct?
Yes, that's very correct. So this is basically, as you say, it's really an add-on, just simply trying to see and realize the fact that some US investors prefer to invest in stocks that are listed on the US stock exchange rather than somewhere in Europe. So so that's really the background for it.
Okay, because I guess that's a lot of people in Oslo, for example, but also in Denmark would sort of say, look, has that got any implications for me? Will I still own my shares in Nest or in Oslo Børs? And
Yeah.
I guess the answer is absolutely yes.
Nothing will change in that respect. It's just an add-on, basically.
Okay, we'll get back to this in just a moment. But this was the key highlights, and then let's dig into some of the financials for the Q3. I think maybe you take a brief introduction, then perhaps a few questions.
Yes, exactly. So I think maybe what's worthwhile noting here is that if you focus on the net profit side, so we had a net profit of just a touch below $147 million, and basically on a year-to-date basis for 9 months, around $617 million. So far, all in all, it's been still a very, very, very strong year. I guess my main comments to the third quarter is that third quarter is traditionally one of the weakest quarters during a year. So, and that has to do with seasonality in terms of consumption of refined oil in general. So what I do think is important for investors to understand, although markets are very, very high and will continue to deliver really, really good results, there will still be seasonality during the year. And that means you're going to see most likely that fourth quarter and first quarter of a year will be the strongest, and second and third quarter will be the weakest quarters of the year. And that is kind of a seasonality that we've known, as long as you can remember back, basically. So there's nothing unusual that third quarter is slightly weaker than what we've seen. And for us, nothing fundamentally has really changed in terms of our forecast for the year and our forecast for the next few years forward as well.
Okay. And I guess a lot of people's attention is on the dividend payout, and you've chosen to pay out 70% this time.
Yeah. So basically, we have announced a dividend policy previously that is linked to our net loan to value. So basically, the fleet valuation of the entire fleet that we have minus debt and plus the cash that we have available. So that number, as that reduces, i.e. that we have less and less debt versus the value of the fleet, we decide to pay more out in dividends. And in this quarter, we came below 30%, and that basically meant that the dividend went from previous quarter 60% up to 70%. And when that number, the net loan to value comes below 20%, then the dividend will go up to 80%. So that's the dividend policy we have at the moment. So yes, pleased to say that the percentage of dividend actually went up this quarter. That's another key highlight.
Yes. If we take year over year 9 months, there is a small decline in the revenue, but also in the net earnings. Do you have any comments on that?
Yeah, so there is no doubt that what we saw last year, particularly in Q2 and 3, was that there was definitely an element of panic due to the war that obviously started in the first quarter last year. So there's no doubt that we saw more activity, more fear, more uncertainty than what we are seeing now. Basically, what we have now is just a what I would call a standard market, but on a very, very high level. What we have seen, though, also compared to last year, is that this year we have reduced inventories of refined oil products. So what you can say is that where last year most of consumption, extra consumption and build up inventory came from transportation, then this year we've had a good transportation market, but we also consumed quite a lot from the inventories and reduced them. So there is that effect as well. So what we're looking at now is that we're looking at very low inventories again coming into strong quarters. So our expectation is that again you're going to see an increased demand on one side, but you're probably also going to see an increased demand from building up of inventory to get up to slightly higher levels than where we've been.
Cool. I don't know if there's any more questions about this. Otherwise, I think we should go into to the more fundamentals of the year. And I think there's also a question about this, about your sort of outlook for both 2023, the reminder, but also 24. And I guess the starting point is if you only cover 13% of your fleet for 24, that is, I mean, my sort of interpretation is that that's a very bullish or optimistic view, because you then expect rates to go up. Is that a fair way of seeing this?
Yes, it is. So basically those 13%, they actually, what they reflect is more strategic coverage that we have. So what I mentioned earlier is like we've been building a few of these dual fuel, future-proof vessels, but because they were slightly expensive to build, we decided to build them against long-term contracts so that we are guaranteed a very good yield over the next 7 years. So that's really the coverage we have. This is all coverage based on long-term contracts. So as you say, our view is that markets will continue to be strong for a number of years, and we're basically in the middle of that process now of just seeing bottom levels increasing and be at these high numbers that we've seen already year to date. So our view is that unless we start seeing 3 years periods, i.e. long-term out at levels that are at today's levels or higher, then we prefer to look at spot basically. So that would be it. But it doesn't mean that we will not take any coverage going forward. I think there's always a level where we feel that, okay, at these levels, it would actually make sense to protect the company. So I think what you should at least have a note out for is that when we look at coverage, it's always mainly based on that we can get 3 years out. We think within 12 months, we are more comfortable in understanding the market better ourselves as opposed to putting ships out.
Cool. I've heard some questions about the LR2 coverage. That is, it seems, you know, you have 13% overall, but 39% on the LR2. Is there any specific reason for the LR2 coverage being so high?
Yeah, so this was basically due to the fact that we had very few LR2 ships compared to MR, Handy, LR1s. So in those other 3 segments, we actually have a big market position. We are one of the leading players. So that means we can use our information to make superior decisions and actually operate the vessels more efficiently. With the LR2s, because it was a small segment for us, we decided that when you don't have the scale, we're actually better off to use that segment as our hedging segment. So that's really the background for it. So as we grow that segment, the more ships we get into it, you could see that will unwind itself a little bit. And maybe in a couple of years out, we'll have more LR2 ships in the spot market, and the hedging will be balanced out through the other sectors as well.
There's I might take a few questions here, Michael. There's a question, say, if we look at your coverage for 24, around 13% of fleet is covered at 23,842, and versus an average of 31,624 for 2023. So the question goes on 24, should we continue to see a pressure on rates into 24?
No, not at all. So as I said, that coverage that you see there is coverage that also was actually part of the 2023 financials, right? So these are not new things. They're actually also part of the current freight environment that you're looking at for Hafnia. So there's no change in that. Now you just see them isolated from the beginning of the year, but they're also the same really for 2023. So these are, as I said, contracts that run for 5 to 7 years. So it has non-relation to our view on spot markets or how things are. This is really around investments in ships and be prudent about covering the downside risk when we did it. So it has no relevance to our view on the spot market as such.
Okay, cool. Then perhaps let's continue with your earnings guidance. I think this slide is, in my view, and maybe you tell me if I'm wrong, this just shows you that what you know as a company versus what the market thinks is actually almost in line. Is that the way this should be interpreted?
Exactly.
Yeah.
And that's not always the case, right? But I think that probably shows in a way that, if you had shown this slide a year ago, as you may recall, and I actually think you probably did, it was very different, right? And I think what it means is that slowly but surely, as these markets have now been going for a year and a half, I think it's becoming more and more evident that the fundamentals are transparent, and I think pretty clear to most people that the analysis kind of ends up the same way, which in a way I think is positive, right? Because what it means is that we're all calibrating in a way around fundamentals rather than sentiment, which I think is on a longer term basis is actually better for the company and for the stability.
Yeah, and this is a personal comment, Michael. I think what's difficult for investors to understand is the longevity of this cycle. Because actually, if you look at this, you are making, let's say, $800 million on the bottom line, and you're valued at 36 billion Norwegian kroner. So it's let's say 4 times earnings. When you have discussions with your sort of investors, what do they say about this longevity? Because it's very, very important to understand if this changes.
Yeah. No, I think I think there's a perfectly good reason why shipping companies, in our view, are valued a bit low, and also are valued more around the net asset value of the company rather than multiples on earnings going forward. And that has to do with history as well. I think if you go back, whatever the last 30 years, what you basically saw is that every time you had a market that went up, these cycles upwards didn't last very long, because what would typically happen is, as you made money, you would buy a lot of new ships, and as they delivered, they would oversupply the market and it would drag you down again. So that's why this volatility meant in a way that you never really got priced for forward earnings, but rather for the net asset value, which I think is totally right and actually a very fair point. The main difference this time around is that the whole supply side of ships have changed over the last few years. Nobody has bought any new ships. And what happened instead is that all the shipyards were filled up by container ships, by gas carriers, all other sectors. So when the tanker market started to grow, there was suddenly no possibility of ordering a new ship and get it delivered unless you waited for 3 to 4 years. So basically what has happened is that the incentive to build a new ship have disappeared, because you get it so far out that it has nothing to do with the proximity to the current high market. So effectively what that means now is that we have a visibility 4 years out where we can see exactly what ships come in, and it's very limited, and demand continues to be going upwards, in the worst case stabilizing. So I think this is the big difference now, is that we're not going to be able to oversupply the market with ships, because that's already closed for the next 4 years.
Cool. And with that, I think we should go into the review and the outlook, because you have many slides on this topic, and it's all sort of backing up that position. So let's start with the demand, because it's clear to, we are talking about, particularly in the Scandi countries, there's a lot about green transition, and it's going so fast. But the reality is that oil demand overall is actually on the increase worldwide.
Exactly.
And do you see any changes to this? I mean, that's the picture you're painting on the oil demand and supply curve. Is that under pressure in any way, in your opinion?
No, not at the moment. And I think that one of the reasons, again, going back to where we are, is of course that the green transition was probably in a way for a few years being too optimistic in terms of when it would happen. So I think everyone got caught by surprise after COVID that oil demand came back so quickly to where it was. And now, according to all the international oil agencies, are going up this year, will go up next year, and maybe you will only reach a peak oil demand scenario in 2030. So that basically means that what we're seeing is that oil demand is still the cheapest source of energy, and a lot of the green transitions will happen later than what people expected. So I think this is fundamentally what the problem is that demand has come back stronger than ever before, but the supply of vessels to carry the oil is slowing down tremendously at the same time as the fleet is getting much, much older. So you have the worst combination technically of two things is that you don't get enough new ships to cover for the older ships that are being taken out of the market. And that's really the key element of why this market will probably stay strong, as I mentioned, for many years out, is exactly for that. We cannot manage to build enough ships to replace the old ships that are disappearing from the market.
So, and then just being very specific on your market, this left-hand side graph shows that the amount of loadings on clean products is actually on a very, very high note in the recent 3 months.
Yes.
And actually higher than last year. So how does that fit with the rates situation?
But this is basically a time lag situation. What that means is technically already now we can see that you're building up for a much stronger quarter because there is more cargo on board ships, which means that eventually there'll be fewer ships available for the next positions that are open. So we see this as a build up to a very strong fourth quarter and first quarter that you already see now more oil that's out on the vessels. So there will always be a time lag in this as you start filling up ships, but it just shows that the underlying strength of the market is definitely still there.
Then let's go to the supply side because and you have a lot of interesting charts here. I just want to maybe start with this this is a new slide you've added, and as I know, with the aging of the fleet. So maybe you can just talk us through about this whole situation on the aging of the fleet, because that's a big part of your supply understanding, as far as I understand it.
Exactly. So basically what you can say is that if you, I mean, what this graph is really meant to say is, just to illustrate very quickly, that we are now getting into this period now, 2023, 2024, up until 2028, 2029, where the bulk of the fleet that was built back in 2003 and 4 up to 2008 and 9 are now getting 20 years up to 25 years, which is the normal scrapping age of vessels. So if you think about it from a high level basis, basically almost 3,000 ships were built during that period back in 2004 to 2008 and 9, and all of these ships now have to get phased out from 2023, 24 until 2027, 2028. So technically you would have needed, as you can see on the graph here, to build a similar amount of ships if you were to just keep the equal level between what you take out of the market of ships, what you put in. But as you can see on the graph, the red graph that follows here, that shows you the new builds that are coming in versus all the ships that are 20-year and older. So there is a massive undersupply of vessels coming in, and this is really the key slide to understand the market going forward. It's the lack of supply of ships that will keep a hand under the market for the next many years.
I believe this is the accumulated of it. So you're basically saying that there's a shortage of 287 ships and 314 ships by the end of 2027.
That's right. And these are, on the left side is the product, and on the right side is the crude ships. But in addition to this, you also have, which becomes a bit technical, you have the difficulty for older ships to actually trade. So what is basically happening now is that older ships, in addition to the ones that are being scrapped, are finding it more difficult to find more cargoes to sail with. So we are seeing that the utilization of older ships is falling as well. So indirectly, you're going to need more ships than these to cover up for the inefficiency of the ships that are not being scrapped, but are just still sailing but being old.
And as I recall it from the first slide, your average age is around 8 years, 8.1, I believe it is. And how does that compare to others in the industry?
So the average of the industry today is probably around 12 years. And as I mentioned, technically when you are 15 years and above, you're beginning to see more pressure on the older ships. But 20 years and above is really where you get into the scrapping part of ships in general.
Yeah. So And this is actually, you have a lot of slides about this. People can find it in your investor relations side, and it's on the presentation we're using here is the investor relations presentation Q3. So there's a lot of backup information about this. This is what the point you are trying to illustrate, basically.
So what this slide basically tells you, if you look from 2019 up until 2023, and you look at the blue column, is it shows you how utilization of older ships versus newer ships are reducing. That means that they are carrying less and less cargo and are being used less and less by the customers versus the younger ships.
Yeah. And also this one, I believe, let's just pause a moment on this ordering activity, because there's 2 points here. The first one on the left-hand side is that the amount of shipyard capacity is simply a lot lower now than it was 20 years ago. That I guess is a major point for you.
Yeah, correct. So there's been a lot of consolidation amongst the shipyards, but that also means, of course, that when there's more demand, it's very difficult to add back this capacity. So that has basically disappeared since 2008. So if you look at the left graph versus the right graph, that also shows a little bit about the potential for building. If you look at the right graph, you can see, because there was so much yard capacity, we basically overbuilt in the years back from 2003 to 2010, 11. And obviously these yards are not available anymore. So even if you wanted to replace all these ships, you couldn't do it within the same time horizon.
No, and there's a question here on your thoughts on the order book, which is around, you right here in your presentation, is 10.6 going on till the next 4 years. So,
Yep.
and the question goes on, at what point will you be, concerned again about the ordering level?
I don't really, well, it's still, I don't have a number as such, but quite frankly, I don't see how we're going to be able to order enough ships compared to what disappears. I mean, even if you took 27, 28, 29, and you built the maximum capacity for product tankers, you would not be able to build enough to what is needed to replace. So, so that's the best way I can explain it. I don't think it's possible to have a number that will scare me as such, because it's impossible to cover what is needed. And secondly, of course, what people should bear in mind is that the new build prices right now are the highest we've ever seen in history. So not only are you buying a new ship, you only get it out in 3 to 4 years time, but you're also paying the highest price you've ever done ever in a lifetime. And you have to remind yourself that that ship has to last for another 25 years. So that means it lasts well beyond 2050, where the world is aiming to be net zero on all emissions. So one have to ask him or herself, to buy a new ship, a new oil tanker, 4 years out delivery, having to last for 25 years at the highest price ever. That's a very difficult sell into any board or owners in general.
Yeah. And that's actually going back to a question coming from the audience here, and that is the rate implications that, the interest rates level have gone up so much. We've debated this several times, but what is your stance on this so far? First of all, on Hafnia, but also on the industry as a whole, perhaps.
No, I think for sure that's another issue in general, right? That obviously it's become more expensive, and I think it'll put a damper, and has done already, on a lot of investment activities. So, I mean, for Hafnia at least, we've covered more than 75%. We've hedged on our interest exposure at around 1.6%. So I think we're in a very comfortable position. But I do think in general, looking forward, when you talk the broader market, that access to finance, access to competitive finance in general will be a problem. So that's another, if you like, push on, are we going to see more new builds? Well, it's going to be very difficult to finance them as well for, if say, owners that don't have access to good finance already.
Yeah. And also giving on this, there's a question on the age again, Michael. It's probably a small repeat, but I just want to make sure it's been done. At what age does product tankers normally reach their retirement age, or what age is that in Hafnia? I hear different ages: 15 years, 20 years, 25 years. Can you please elaborate a little bit about that?
Sure. So I think if you look at the average scrapping age, so if you look at all the ships being scrapped within the product tanker segment, what average age do these ships have? I would reckon today is probably 23 or 24 years. So that it would be the statistical information today. So what you hear about age is that at 15 years, that's kind of that's what we call like one of the first big thresholds, because that means when you go into a dry dock, you have to measure the thickness of your steel, and you have to do a lot of upgrades on ships for them to be able to carry beyond 15 years. So 15 years for a lot of our clients, for the oil companies, is a year where they start looking more thoroughly into the ships before they accept them. That doesn't mean they can't trade. They can trade very well. But what it means is that if you are a ship owner that has been unwilling to invest money in your ships, it will be tough to trade them after 15. So what it basically means is that owners that are less willing to keep their ships in a good condition will start seeing problems from 15 years onwards. Other owners like ourselves and most of, let's say, the global players would not find an issue quality-wise, but it's just something you need to be very much aware of, that it costs more money to maintain after 15 years.
Cool. I think we are reaching the end. Michael, thank you very much for your thing. And the final question would go on the Oslo once again. And what is the timing line here on your New York Stock Exchange thinking?
So we haven't put any timing on it. That's normally because these things are a little bit uncertain. But what we are saying is that the process has started. So I think the best guidance one can give is to look at other companies from when they started to when they finished, right? And I think if you look around on similar processes, it has probably, in most of these processes been like, probably a 6 months process in general. But we're not giving any accurate timing on exactly where. But that's kind of been the standard, I would say, of companies that have been moving across.
Okay. Thank you very much to the audience. Thank you very much to you, Michael. Thank you for participating. And if you have any questions, please call or write us an email, and then we'll get back to you. Thank you very much for your time.